All right, maniacs, welcome back. I'm cutting straight to the chase. My name, yes, my last name is Money. My first name is Chase, but more importantly, you are 24 hours away from the most important non-farm payroll report of your life. And let me tell you this, it's not just any payroll report. No. This is the non-farm payroll report that will make or break everything. So nothing else matters apart from what I'm about to tell you in the next 5 minutes, because I'm about to set you up for life. So stop whatever you're doing, take a deep breath, like this video, and let's roll the tape because your future self will thank you. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of red, really bad breath across the board, except in energy as well as certain parts of technology. Meta up 1.74%, as well as Nvidia, semiconductors, and certain stocks here in software. That was really it. It was very red across the board. Now, energy saw a huge energy spike. As a result, these stocks gained. I think energy was up anywhere from 3 to 5% today, up 8% so far this week. Very volatile moves, has to do with Middle Eastern tension. And I think the reason why semis were up today is because there's a lot of news circulating. Number one, about Nvidia's partnership with Accenture. People are really bullish about that. But there's also a lot of news about OpenAI, their funding rounds, and that's obviously going to benefit semiconductor sentiment. And that's why we saw Nvidia up today, as well as AVGO, AMD, Qualcomm, MU, Dell, Accenture, IBM, these names, as well as some names here in the infrastructure space, particularly security names, Palantir, CrowdStrike, PanW. So a lot of the tech names moving on the fundamental news, a lot of the market moving on the macro geopolitical tension. And that's why we saw energy and tech were the best performing sectors, up 1.8% and 0.5% respectively. Utilities were flat. Utilities are somewhat a play on energy as well. And then the rest of the market was actually a bit of a dumpster fire. Very weird. We actually saw yields rise today, and that's why real estate was down 1%, financials down 0.5 percentage point. The worst performing stocks being discretionary as well as materials mostly from the Chinese unwind we're seeing, and consumer discretionary had to do with the price action we saw in Tesla after their deliveries miss, as well as Amazon, which just took it on the chin today, and that's why discretionary was the equal worst performing sector along with materials. All in all, a very rough day across the board in the S&P 500, small caps as well, and globally too. We saw a very red day here in China. Definitely some profit taking happening after a 30% plus rally in just a couple of weeks. We saw the same in India, the Southeast Asian regions as well. Japan was green, Australia and New Zealand were green. The Eurozone was very red. They're very close to the Middle East, and the markets are going to react accordingly. And then the US markets were very red. So a brutal day globally. The markets that really impact the global market, like US, China, Europe, India, they were red. And that's why something like the All Country World Index, the ACWI, was down like 1% today. But the geopolitical news wasn't the only news moving the market today. We also got a slew of data that was actually rather positive in my opinion. Initial jobless claims beat expectations, 225 versus 220 forecast. US final services PMI came in at 55.2 against a 55.4 forecast. But what really matters is actually the ISM services number. This is the data set the street look at, and it actually blitzed forecast expectations, 54.9% against 51.8, and then factory orders did fall. But this data is showing us that there's still no sign of major US layoffs, and the economy is hanging in there, particularly as the ISM survey hit an 18-month high. And today's price action with the data was very weird. These solid manufacturing data as well as initial jobless claims, both are high quality, high frequency data sets, actually sent yields higher, particularly in the long end. The 10-year yield and 30-year yield rose, but so too did the 2-year yield, which normally doesn't happen when you have Middle Eastern tension, telling us that a lot of the rise in yields was predicated on the stronger economic data we got today. So yields rose on the back of stronger economic data, bonds fell, but the US dollar rose as a result, and that's because of all the geopolitical tension we're seeing. The dollar is a safe haven bet along with commodities, and that's why we saw a bid up in all commodities except gold, which was virtually flat in comparison to what equities did today. And higher yields and a higher dollar, along with the sentiment around the Middle East, all just weighed on stocks today, and that is why stocks fell significantly. Now the S&P 500 down 0.17%, Nasdaq down 0.5%. Now this was largely due to some of those big semiconductor names holding everything together along with Meta, but then you actually go down the pile, you can see the IWM down 0.67%, the RSP down 0.47% as well. Mid caps and the S&P 600 fell as well. Now let's dive a bit deeper into the S&P 500. And guys, despite all of the news, the sentiment, and the things going on globally, along with China and Europe, the Middle East, all of this news compiled together, the S&P 500 is still hanging in there. Buyers are coming in at the gamma flip level. Yes, we're getting sold to that level, but buyers are also coming in a very, very strong way. If we dive into the 5-minute chart, look at the 1-day price action, we sort of see the second we get near this level, we often see a huge bounce back. That happened today, that happened yesterday. And that's just the thing about bull markets. They tend to be very, very resilient because buyers have a ton of conviction, especially when you're up 20% for the year. Now, there's a couple of things we need to pay attention to here that's actually causing the sell-off. One of them is actually the buyback blackout period. You know, we're entering the third quarter earnings season. Buyback blackouts start anywhere from pretty much right now all the way up until the end of October. We also see a ton of tax loss selling in this October period. For the next 2 or so weeks, we'll see a lot of tax loss selling, especially as we have certainty into the election. So, you know, the buyback blackout period with tax loss selling is resulting in a lot of the sell side we're seeing in this month. And that's why seasonally we are in this weak period, because that's when big funds do their tax loss selling. It just so happens that we're also getting all of this sentiment and geopolitical news at the same time in this very, very weak month. And that's resulted in the S&P 500 pulling back from its highs and sort of consolidating here, I guess, at the 56.75 area. Nothing has changed for the gamma flip. We are still in positive gamma, and that means you buy dips, sell rips, aim for the 5800 area. In negative gamma, we would look to the 5600 area, but we really go with the trend. So if the trend's moving lower, we would sell into it. If it's moving higher, we would buy into it. All in all, on a technical basis, you can see these are very constructive levels. This area that's acting as support was previous resistance kind of right here, as well as right here. We do know that resistance often does turn into support, vice versa. And this is exactly what this is showing us right now, giving conviction to the bulls. All in all, guys, if we do slip below this level, things can get really ugly for the S&P 500. But for all of the news that's happening, for everything we're seeing in commodities, the dollar and yields, the markets, especially the S&P 500, is holding in there. Looking at the Nasdaq 100, a very similar situation at the gamma flip zone. You know, if we do break below, things can get ugly. However, looking very resilient in light of everything we've seen. Things not looking that great here in the Russell 2000. The IWM was down 0.67%, down here in the after hours as well, in negative gamma officially, which probably means we now target the 2150 area. That's not a pretty candle. We did see some buyers come in at the lows right here, but again, you probably do just want to wait for this to hit the 2150 area or around there. Not pretty in negative gamma. And generally speaking, when people are going to go to cash like we have been seeing in the last couple of days, they're going to sell out of their lower quality names first, then their higher quality names. And that just starts with the Russell 2000. And that's why we saw the Russell, the worst performing size segment here today. However, I'm still constructively bullish as long as we're above this lower low, because this looks constructive. Like, you've got a low right here, a higher low in the context of a 52-week high at this point, and then we made this low, and now we're actually just looking to put another high and another higher low. If we, let's say, put a low right in here, or before this level, we put a low somewhere in here and continue to move higher, break these highs, break the 2275 area, that's just trend continuation. And what we're seeing right now would just be sort of like weekly and or monthly noise in the context of the bigger picture in the IWM. All in all, though, we are in negative gamma, so you do want to remain on the side of caution. And if you are looking to get in, maybe look at the 2150, maybe 2175 area if you want to get in a little bit early, and you can buy on the way down. Equities are very, very mixed. We are in a clear downtrend, especially in the Russell, but we are in a clear daily downtrend, and that could mean more volatility especially if we break these gamma flip zones. Looking at the equal weight, the key level we're looking at is the 176 area. Very, very resilient, a daily downtrend as well. But this is the first level of support I'd look to buy. Below the 176, I think we then target the 172, but very, very resilient. Buyers did come in at the lows here in the RSP, and this chart looks very, very strong in my opinion. And you don't really want to fight the trend. You do just want to ride the trend and buy dips at strategic places. And the first place is 176. The second place is 172. Diving into sentiment, this is the AAII sentiment survey. And guys, we see a very similar dynamic to what we've seen probably for the last 6 months. Elevated bullish sentiment, subdued bearish sentiment. This is telling us we are in a bull market. You need bulls for a bull market, but we have seen bullish sentiment tick down in a very big way from the highs we made here in mid-September. We were at 50% when the market hit new all-time highs, and since digesting a lot of the price action in the last 2 weeks, we've seen bullish sentiment tick down, bearish sentiment remain flat. Net, this has weighed on the market, but you do have to understand that 45.5% is still very bullish considering the historical average is about 33%. So all in all, things are looking very bullish, and bullish sentiment often precedes bullish market momentum, and nothing is more bullish than market breadth expanding. And market breadth right now is very, very strong, and it continues to improve. The percentage of stocks with positive returns over the last year sitting at 85%. This compares to the long-term average, the 20-year average of 67%. And when you look at it in aggregate, this does not typically occur in recessions marked by this gray area right there. And when stocks rally as they have, they can go on positive streaks for multiple months. And currently the S&P 500 has been positive 10 out of the last 11 months. And generally speaking, when we've had that type of price action, it bodes well for future returns. Every time we've had 10 gains in the last 11 months, we have seen positive returns 12 months later. 12-month average return sees 12.6%. This compares to the S&P 500 average of 10%. And guys, there was only 2 years when we weren't positive in the 12 months following. That was 1929 and 1983. Both saw the S&P 500 down 11.5 and 8.9% respectively. But did that forecast a business peak in the next 12 months? In every instance, it was no, except in 1929, which means we can see upside in the next 12 months and probably further upside because the business cycle has not peaked. So guys, this bull market we're seeing is strong and it's got legs to continue moving forward. Now, this isn't a crystal ball, but we do need to look at the drivers of market momentum that's gonna drive returns in the next 12 months. And one of those factors is actually the Fed. This is the Fed's Speak Index, and sentiment is finally below the zero line. We're seeing a lot of dovish sentiment below this line. It's dovish above, you're looking at hawkish sentiment, and do expect this to continue, especially as we get rate cuts, because we are currently at the start of a cutting cycle. And generally speaking, that's very bullish for equities, especially when the Fed goes on a slow cutting cycle. You can see slow cycles right here have the best 12-month and 24-month returns. Fast cutting cycles actually see positive returns, but not as good as slow cutting cycles. And this green line right here is actually what happens in a recession. Now, the reason why slow cutting cycles are really good is because the economy normally chugs on very, very well, and we're normally cutting rates to normalize the cost of credit versus trying to save the economy. And that's why slow cutting cycles do very, very well, because the Fed don't need to cut as aggressively to support the economy. And that's what we're seeing right now. Yes, the Fed did do a 50 basis point cut, but Fed speakers have come out and voiced their opinion that they probably see 25 basis points in the next cut and then 25 in December as well, telling us that we probably are due for a slower cutting cycle than the market expects. That's why we've actually seen quite a lot of volatility in yields to the upside and downside, because the market was pricing in a lot more cuts than the Fed was expecting to in the weeks following the Fed cut. That means we're in a slow cutting cycle, and 12 months later you can expect to see returns of about 20%, and 24 months later you can see returns as high as 37% in the S&P 500, assuming we continue the slow cutting cycle, the macro improves, and the consumer hangs in there. Now, along with equities doing very well, commodities also do very, very well in cutting cycles. And I have some very interesting data here from Citibank as well as the Silver Institute. And the Silver Institute estimates that the demand for silver right now is outrunning supply in the last 3 years, and it projects another deficit here in 2024 when demand outstrips supply. Very good things happen to price, and a big part of this demand has to do with industrial demand. Electric vehicles use a lot of silver, and we're simply not pulling enough silver out of the ground. Eventually, demand will meet the reality, and that's going to see a huge upward surprise for silver. So if you're looking to diversify your portfolio, silver is one place. Another place could be gold. This is Citi's view right here. Now you can go ahead and actually read what they think about gold in this paragraph right here. They forecast gold to end the year at $27.50. The current spot price is $26.60. They see the first quarter return $28.50, and the third quarter, so exactly 12 months from now, they forecast at $2,900 currently. That would represent 10 or 11% upside from where we are right now. So very healthy returns, and there's a lot of tailwinds behind silver, behind gold, rate cuts on the table, liquidity, China. So if you are looking to diversify your portfolio, look at metals, but also look at China. Whether you hate it or love it, data is data. And when China has registered a 10-day change above 30%, the forward returns are very, very strong. This has only ever happened twice, and in both those instances, we saw the MSCI China index return 52% and 70% 12 months later. Definitely not without some volatility. There certainly was volatility along the way, but if you are looking for great risk to reward right now, I think China is a place you want to look at. Just don't forget to discount the risk accordingly. Diving into the macro, this is the Dallas Fed's weekly economic index, very similar to the Fed's GDP now, sitting at 2.7%. They also have second quarter GDP tracking at 3%. Very robust figures. I will always say that, economic growth anywhere from 2 to 3%, that's exactly what you want. It just means solid economic expansion, and that's exactly what we're seeing. We also had a fantastic jobs report yesterday from private payrolls. ADP reported 143 private payrolls. Consensus was 123,000. There was some real doomers on the street suggesting below 100K figure. ADP private payrolls blew it out the water. We saw increases in every single segment except 1 to 19 employees. And this figure right here, 1 to 19 employees, it doesn't really matter to some degree because ADP really caters to like the larger scale enterprise software. 1 to 19 employees, they're really losing market share to stuff like Paycor and the smaller payroll providers. So all in all, a very solid private payrolls report. While it doesn't forecast NFP to the number, it does show us that the direction is up, and more often than not, a strong ADP report reflects a strong non-farm. So I'm looking forward to a strong non-farms figure in tomorrow's data. And we're also seeing this in federal employment tax receipts. We finally capped off September plus 4.8%, very strong. We're seeing in the trailing 12 months 3.8% total federal employment tax receipt growth, held back by a negative 8% figure here in December. Remove that, and this figure is looking very, very healthy. That's exactly what you want to see. That just tells us employee compensation is robust and disposable income is looking very, very healthy. Now, the big thing that's going to move the market is tomorrow's NFP, and BOFA is forecasting 150,000 in non-farm payrolls. This is above last month's number of 142, and I think if we just come in line, I think the market's really going to like that. And based on the ADP report and the JOLTS data we got this week, I think we can actually see a beat above this number, but it's also going to depend on the dock worker strikes and also Hurricane Helene. So we're going to see what that looks like for the NFP. Regardless, guys, if we get above a 150, especially when the Fed's focus is the labor market, that's going to be very, very healthy for markets and going to support the market. If we miss, I don't think it's really going to matter. I think the market's going to look at other factors as to why it missed. Regardless, the number we want to look at, guys, is 150,000 non-farm payrolls. That's the number. That's what we want to beat. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.